Actively managing a passive investment means like you can actively manage ETFs. You can
Correct.
say, hey, large cap growth is doing better than small cap value.
Mm-hmm.
Right? So you can actively choose to be in large cap growth and actively choose not to be in small cap value and then own the ETF to do that.
Yes.
So, and one of the things that I think is really attractive about it, there are other people that actively manage passive investments.
Yep.
I just invented it. Okay. Okay. Like, right. I am the godfather of actively managing passive. Okay. No, I'm kidding, obviously. But I think that actively managing passive investments has a couple other things. You can be tax efficient, fee sensitive.
Yep.
Because those passive investments are pretty cheap.
Correct.
Okay. And you can be globally diversified.
Yeah.
So again, to just use our exchange traded fund strategy as an example, because clients are probably familiar with it if they're listening to it. And it's easy to explain for somebody that's not invested in it. But if you're actively managing those passive investments, you have a component that is domestic US, and then you've got the international, and you can break that international down into developed markets and emerging markets. And then instead of just being in one passive investment, like, for example, the EFA ETF, EFA, which just tracks the performance of the developed countries, you can break that down into different countries.
That's what the value is for me.
You can be in Germany, you can be in Italy, you can, and then in the developing markets, you can be in things like Poland and Israel and Turkey or Turkey, however they want us to pronounce it these days. So, but that's really what's fascinating about it. But you're still in these tax efficient, fee sensitive, and globally diversifying a portfolio, all while actively managing those passive investments. Because again, when you choose an active manager, you got to understand their philosophy. So because this is an active strategy, you've got to understand the philosophy, which is, hey, we want to be in the things that are doing well.
Yep.
And not in the things that aren't doing. It's not like if everybody can close their eyes and think of a tic-tac-toe box with 9 squares in it, that's kind of how you can think about the big size and style investment allocations. Yep. Large cap growth, large cap value, large cap blend. That's your top part of the tic-tac-toe box. And then mid cap growth, mid cap blend, mid cap.
Same.
Right. And then small, right? So you got 9. A lot of asset allocators will say, well, we're going to have a passive strategy and we're going to have a little bit of everything. So we're always guaranteed to be in something when it's working. Okay, that means you're always guaranteed to be in something that's not working.
Yeah.
And that gets to your point, which is it can be difficult to behaviorally be in something that's not working.
Well, and I think it's just being really intentional in this kind of strategy that we operate here. And I think we probably should cut another episode sometime down the line here about specifically how we decide which parts are working and don't work.
Right.
But for this conversation, I think, again, the developed markets is a great example because you see places in the world that aren't doing as well. Maybe it is Japan, for whatever reason, is not doing well. And, but Korea is, or Germany is, to your point. But avoiding the parts that are kind of dragging you down, sure, maybe that someday they'll recover, other parts turn over. In a passive investment, you're kind of accepting that you're going to have winners, you're going to have losers, and they're going to average out. By actively managing passive funds, you're really trying to focus on that winner's space. And still, to your point, be cost sensitive. There's a lot of ETFs out there that are starting to be what are called active ETFs. So you can just buy an ETF and it's the same thing as buying like an active management strategy through a mutual fund or working with Monument. But sometimes those fees on those funds, those internal expense ratios, they're very high.
Yeah.
So it's more about how can you blend it together. And that's, again, why I like our core ETF strategy, the one that you were talking about. It is fee sensitive, but it's actively managing those passive funds. You get the benefit of the passive funds,
right?
But also you get some benefit from that active management too.